Welcome to another episode of Navigating Carbon, your compass to carbon management. I'm your host, Deb Ryan, and this week on the podcast, we explore the topic of financed emissions and what is meant by transition finance. To do this, I'm joined by Andy Bose, Senior VP of Market Development and Policy at Future. Andy helps to define what transition finance actually means. We discuss emissions performance and also dive into the conversation around risk and what that means for the markets. I've also linked some articles in the show notes that we referenced during the discussion. As always, if you would like to stay on top of all of the upcoming episodes, please like and subscribe to the podcast. But for now, sit back and enjoy my conversation with Andy. Thanks. Hi, and welcome to another episode of Navigating Carbon. This afternoon, I'm here with Andy Bose, who's joined me to talk about all things transition finance. Andy, hi, how are you?
Hey Deb, good to see you. Doing very well. How are you?
Good. No, I'm super excited to bring you into this conversation because there's a lot for us to kind of unpack and talk about in terms of what transition finance is and really where this market's going. But I wanted to really start with you work for a company called Future. Like, do you want to give us just a little bit of an overview about who Future is and what you guys are doing?
Yeah, thanks. Thanks for that opportunity. We are Future's an early stage company. We are focused on efficient use of capital in the transition economy to get scale to solve all kinds of different problems in the physical commodity world using digitally verified data to assure that you're getting the types of environmental impact that you would want to get. We're able to do this because we've been using software and technology and governance systems that we've built out over the last 4 or 5 years that are now finding kind of traction in the marketplace in terms of people trying to solve those types of problems.
Really cool. And one of the big problems, I think, and you and I have talked about this a lot, but you recently contributed to an article that I'll link in the show notes for everyone. They can take a read about it around transition financing and kind of what this means. Like, can you explain for everybody when we say transition finance, what does that mean?
Yeah. Thanks for the question. It's a really important one. What we've noticed is that people are trying to solve environmental problems by allocating capital, but not having really good tools that they could use. We've all been innovating in this space around items that are labeled green or sustainable or renewable, and they all mean different things to different people. They've tended to be areas where there were kind of innovations in the business model as to how things might get done, and it required innovation as well as to how the impacts would be measured. Transition finance right now is a mechanism that says, let's look at how we have always traditionally done finance over the last 10 to 30 to 50 years, but add components of this digital information that I was just talking about so that you can actually validate that the outcomes that you want to see are actually happening, but it's within the space of the finance that you would otherwise already do. So you're not trying to necessarily create brand new products, but instead modifying what you already do to create the outcomes that you want.
So understanding this and diving in a little bit more. So like the idea of like in the transition risk using things like carbon intensity and other metrics in traditional financing. Is that kind of like what you're meaning by that?
Yep, exactly, right? So
Yep.
that you're able to say that if we were to take a look at our portfolio and we wanted to drop the carbon intensity of all the lending that we do if we were a bank, then we should be interacting with our borrowers to get them to actually measure the true carbon intensity of the activity that they have underway. And then we use that as part of the lending, right? But then we also look at all the other factors that we would normally use as a bank in terms of credit risks, et cetera, and factor all of that together to create the package for the borrower. And so really the ad here is to make sure that people know what they can ask for,
Mm.
and how that can be utilized in the lending.
And that makes sense. So like, as the banks and sort of are looking at this capital allocation and financing and things like that, like it's often at least from my understanding, it's often sort of through this like risk kind of, making sure they're like being, thinking about risk in terms of what that capital is going to look like. So how does emissions sort of factor into that, or how are banks and financial institutions really incorporating emissions as part of that overall risk profile? And I guess, are they, with what you're talking about?
Yeah, absolutely, right. So I'm going to spend a couple minutes on this and kind of redirect me if we need
Yeah.
to. There's at least three areas of risk that the banks are looking at, right? The one area of risk is um, with the borrowers themselves, right? What are the credit risk factors that they need to be considering? And especially in hard to abate sectors like oil or natural gas production, um, is there anything that additional information in terms of the environmental impact that those companies are creating, can that be measured and that can that be reduced? And therefore, the better performers will have, most probably a better credit risk, and the performers that are doing less well will probably have a higher credit risk. So there's a credit risk conversation around the entity itself. Then there's a credit risk discussion around the institution that's providing the capital and whether or not it's made any net zero commitments, and how does it measure the change within its own portfolio in terms of what it's doing against its own published targets. And are they assured that they're really heading towards the outcomes that they expect to get themselves, right? So that's balancing who you're lending to and what you're lending for against your own bank targets. And then the last piece is really, are you staying within bounds of regulatory commitments, right? So if you're staying within bounds of regulatory commitments by being able to measure this information, that's great. If not, then what's the next step that you need to take in order to get to where you need to be? Those are all metrics around the downside that is part of the risk measurement. The other part about it is just understanding what your competition is doing
Mm.
and what your business opportunities are, right? So the better off that you are in terms of being able to manage and measure these environmental attributes, the stronger you'll be in terms of building out your business, right? So that's another part of the risk
Yeah.
equation
So
for them.
then banks looking to, like players either in the chemical space or in the oil and gas space and stuff, and really looking at the peers and doing benchmarking around emissions and carbon intensity
Yeah,
to assess
absolutely.
that.
Yeah,
Yeah.
and
Okay.
and and knowing who the best entities are that you should be interacting with,
Hmm.
and then maybe taking decisions that you won't be providing funds for other entities, right? And then trying to win that business. So it's both kind of the downside management as well as the opportunity management.
Yeah, I think, and I like that you framed it in terms of opportunity, because I think when we often talk about emissions and some of this stuff, everyone automatically thinks of it really negatively. But for some people in this market, there is going to be some really big opportunities and things like that. So,
Absolutely, right. We're seeing that for sure, right? Well, there's so many different participants in these markets, and there are absolutely those who see this as a way to win business, right? And expand their portfolios and take leadership positions where they might not have had it before.
yeah. And
Yeah.
kind of staying on that topic for a second, like, and again, something you and have talked about before, but the idea of like emissions performance. We're used to seeing companies with their financial performance, but like, like how that's going to evolve, and how do you think that's going to allow companies to differentiate, and how do you think that kind of emissions performance like sort of idea is going to evolve?
Yeah, well, so there are absolutely already companies. We tend to be in those hard to abate sectors, right? So I'll just continue to use oil and gas as the example, but we could look at mining and metals, and we could look at other areas where it is not easy, right, to show that you've got an improving performance, right? You have to spend the capital to put in sensors so that they can get the information out. You have to have a view as to what kinds of metrics you want to be measuring and reporting on. But the better you define what you're doing in the marketplace, the better you show the validity and the integrity of the data that you're using when you show your emissions performance, the better off you're going to be in many different factors. You're going to be better off in terms of just how you're viewed in your marketplace itself. You're going to be better off as a producer, let's say, in how you're able to attract additional capital to fund your operations if you need it. And at the end of the day, you also have the opportunity to differentiate your product and potentially generate additional profit for the business in doing something that's really oriented around something that would otherwise have been thought of as a drag on your business, right?
Yeah.
So it's a great opportunity.
Yeah. Yeah. This idea of someone paying a premium for a traditional commodity because it can be demonstrated through data quality and life cycle assessments and emissions accounting to be low carbon, essentially.
You got it. Yeah,
Yep. Um,
absolutely.
so I want to stick on the metrics conversation for a little bit because, in
Yeah.
terms of trying to figure this out, I know I'd sent it to you earlier, but there was actually an article today that came out about JP Morgan publishing their like green financing to oil and gas or traditional financing kind of metric that they put out. We've been talking about carbon intensity. There seems like there's all these different metrics that financial institutions and the industry are really trying to use. Like, are you guys seeing that as well? Or are you starting to see alignment around any particular metrics that people are looking at in this space?
Yeah, so there's three levels, I would say, of metrics reporting, right? The example that we used when we interacted earlier today is kind of at the highest kind of abstracted level, which is this is the total amount of funds that we've allocated into certain categories of lending, right? Which could be lending towards renewable projects versus lending towards traditional, old school oil and gas asset lending, right? And that gives one sense of, the activity that's going on in the marketplace. There's another one where you've got self-attestations or self-reporting of data against guidelines, and that's where companies will collect information internally and report that back out either into the general public and in their corporate reporting or back to their lenders. And then the piece where we are spending the most time as Future and working the most with the financial institutions and their borrowers is really getting down into the essence of what's impacting the environment, right? So that you've pointed out some of them. That could be carbon intensity associated with their operations. It could be the emissions of methane into the atmosphere and how that could be measured. It could be the amount of water that's been utilized in a particular activity and has either been reclaimed or can't be reused. And all of those things are extraordinarily important. There's a call for measuring that in the public. There's a call for measuring that in certain regulatory jurisdictions. And I think the hard part about this is there are many, many different uh, 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 standards or different protocols that you could use to do those measurements. There is the beginning of some consolidation there. And what we're trying to do at Future is to provide a mechanism that says, depending on who you are and what you need to measure, our technology, our platform will allow you to use different ones until there becomes that consolidation. And I think that's really important no matter how an entity is trying to get after reporting, is to be able to say we are going to have to evolve because I think the next 1 to 10 years is going to be a continued evolution and really some revolution in the data that's going to be required.
So, Andy, you talked about all these different frameworks and standards and stuff like that we're actually, we're seeing sort of playing out and starting to see some consolidation around and stuff. Do you see that there's also sort of confusion around how industry and the banks are talking to each other in terms of these, there's different metrics and different frameworks? Like, are they even talking the same language, or are we starting to see some alignment in that space between at least industry and the banks what information's being shared and what data's being asked for and some of that kind of stuff?
Yeah, that's a great question. So I think there's really three different kind of focal points that we can talk to. So the industries themselves know that this type of measurement and metrics are going to be important, and they are creating consortia to make sure that they get after this and create some definitions. And of course, it's going to have basically an industry-centric point of view as to how to do that, what to measure, what can be measured, and what's maybe very expensive and difficult to do. And I would say on the other side, we're seeing internationally a group of regulators that are also looking to try to understand what they need to create in terms of their expectations in their marketplace, right? So that could be the European Union, it could be any of the country regulators in Japan, Korea, around the world, the United States. And then the third focus area is the lending institutions themselves and what they should be expecting. What I'd say right now is there's the beginning of a way for all that to coalesce where it typically starts with the industry-led information that then gets evaluated and particularly by the regulators themselves to see whether or not they can utilize that. And you're going to find areas where the regulations endorse something entirely, or where the regulators endorse parts of it, but there's more work to be done. And then what we've seen so far in our conversations with the lending institutions is if you get to that point where either a regulation has been stipulated or it's at least endorsed an approach, right, that the industry has put together, then that's what the financial institutions will tend to want to use, right? Because it lowers kind of the uncertainty with respect to whether or not this is going to be endorsed and then continue to be utilized over the next set of years. And it's really not where the financial institutions have the greatest depth of expertise, right? The industry itself does,
That makes
and then
sense.
those regulators who are, tasked for their activity, right? That's really where the locus is. And I'd say, we're starting to see some areas where the industry and the regulators are well harmonized, and then there are other areas where there's a lot more work to be done. But we try to make sure that at the most granular level, right, we're able to capture that set of requirements and put that into the hands of the financial institutions who are doing the capital formation and
Yeah.
lending.
And then you sort of started to talk about the EU, and I wanted to kind of talk about this more globally and stuff. Are you seeing a different appetite around using some of these metrics and things like that from different parts of the world compared to others? I know you're talking to people all over the world, not just here in the US. Like, what does some of that global appetite kind of look like around incorporating metrics into capital lending decisions and stuff like that?
Yeah. So the way it's working is uh, the regulators around the world are saying this is what our base level requirements are going to be if you want to be able to import into our market at all, right? And so they'll define what the carbon intensity might be for the carbon border adjustment mechanisms, or they may say, for the very important question around methane, here's what the EU methane regulation would be. We are seeing as well harmonization of by the regulators around the world as to how that can all work, so that anybody who's operating in a global marketplace has some consistency. So we may see all the other regulators, as I said, in Asia, in Europe, and also in the Americas, right, start to consolidate. We're seeing some leadership even out of the US and the Department of Energy as to how you might be able to capture, measure, and then validate and distribute that information. So all of those things are starting to absolutely harmonize. And then where that then comes into the banking is then the banks can then say, okay, if you can show me that you can meet that harmonized set of regulation, then we will be able to provide lending. If you can't show that you can do that, then we have to have a different discussion, right? So
Yeah.
I really think that at the end of the day, the capital is following kind of that lead of what's going to be required of the operator in order to be effective over the next 5, 10, and 20 years.
Yeah, that makes sense. And, I think it's really where this starts to become a much more global conversation. Like commodities are traded globally.
Oh, yeah.
And so, we can't necessarily just have our blinkers on in any one part of the world. It's, and I think that's where, things like LNG that are very global markets are going to be a really interesting space for us to kind of keep an eye on, I guess, as some of these more global cross-border adjustment mechanisms and stuff like that come into place. So,
Right. A lot of these markets, when they're global, they're waterborne, and we've seen over the last 10 years, right, so many different shifts in these waterborne markets, right, depending on what the regulations are, depending on what the local conditions might be. You could see, a flow of goods that had been reliably going from one place to another, just absolutely shut down and then flip and go to another market because maybe you can't achieve the requirements in that market, or you just get a better premium for your good in that other market. So the global markets are constantly shifting. And what's very important for the bank is to understand whether or not in all of that shift, their borrower is still going to be a viable
yeah,
entity, right? And to be a viable entity, the banks are now saying, I not only need to know the quality of your physical operation, but I also need to know this other information around the environmental impact, because at the end of the day, we have to make a considered decision as to whether or not over time you're still going to be a good credit for us.
yeah. Coming back to some of those more traditional kind of like financing metrics and mechanisms around credit risk and stuff. So yeah, really
Yeah.
interesting. So, getting to the end of our conversation stuff, when you and I sit down in like 12 months time or in 5 years time, like how do you think this kind of space will have evolved and grown? Like, where do you think it's heading? How do you think, what do you think are going to be some of the main drivers to really make this kind of a really common kind of practice in lending with financial institutions?
Yeah. So the big changing elements are that the financial institutions, having seen that this is really going to be the permanent wave, right, are building into their lending the ability for their borrower to put all this instrumentation and put all the practices of collecting that data, providing that data, and then making decisions around that data part of the common lending that they do to with their borrowers, right? So I think what you're going to see is a lot more instrumentation around the world as to what's actually happening, a lot more measurement, and a lot more both penalty but also benefit to people who have done that and then can really show their environmental performance, which is what you were asking about
Mhm.
a little bit earlier, right? So I'd say 3 and 5 years from now, we're going to see a much better way for people to actually understand what's happening to the environment. What you read in the headlines these days is all kinds of things where people say a totally unexpected or never before seen environmental impact from like a plume of methane emissions, right, has been discovered, right? We should see a lot less of that, right? Because we're going to start to see that being measured, right? Or we're going to see areas where the efficiency of an industry is greatly improved because the lending decision is going to say, instead of taking kind of what seems to be cheaper, but a more environmentally, unfriendly practice, we're going to lend to something that may take more capital, but at the end of the day is actually more efficient for your operations than it would have been before, and it has a lower environmental impact. Those are the kinds of things that we would expect to see, and that's really what that transition economy is about. Is not just substitution, away from coal to a renewable supply, which is incredibly important and it's going to continue. But even in those activities that would traditionally have been financed, we should see that they're absolutely operating in a different way, and that everybody has a lot more confidence that when they deploy that capital, that they're going to see what they expect to see in terms of the environmental outcomes.
Yeah. No, I love that. And I think the point that you made around, I feel like, yeah, early on this conversation of like, we're just going to electrify everything. That gets us a little way through the how we reduce emissions and stuff. But this idea around how we decarbonize the industrial sectors and figure out where that is, really kind of like is the next stage of this. So it's really cool to see how the money is kind of following some of that. So
Yeah, absolutely. I'm very bullish on the types of impacts that we're going to see in the next several years. It's what got me excited about this, and anything we can do that helps make a better capital decision in this marketplace is really what gets me excited. So,
I
yeah,
love that.
hopefully in a couple of years we'll be having this discussion, saying, "Look at these
Look
changes
at all this cool
that have
stuff that we
happened."
did. So
Yeah,
I love that. Well, Andy, thank you so much for joining me today. Super great conversation. And yeah, really appreciate your time.
right. Thanks, Deb. Thanks for having me, and we'll catch up soon.